Introduction. Definition of personal finance. Welcome, friend, to this exciting journey towards financial mastery. We're about to delve into the world of personal finance, and I couldn't be more thrilled to be your guide. For those who may not be familiar with the term, personal finance refers to the practice of managing your money in a responsible and effective manner. It's about understanding your current financial situation, setting goals, making smart financial decisions, and taking control of your finances to achieve your desired future. Please note that this audiobook is for educational and informational purposes only and should not be considered financial or investment advice. The information provided may not be applicable to all individuals and may change over time. It is important to consult a financial advisor before making any financial decisions. The creators and publishers of this audiobook cannot be held responsible for any loss or damage resulting from the use of the information provided. Personal finance covers a wide range of topics, including budgeting, saving, investing, managing debt, protecting your assets with insurance, and much more. And most importantly, it's about aligning your finances with your values and long-term aspirations, whether that's saving for retirement, paying off student loans, buying a home, or pursuing your passions. Personal finance is all about taking control of your financial life so you can live the life you want worry-free. And in this comprehensive guide, we're going to cover all the essential topics to help you master your money and build wealth. So buckle up and get ready to take your financial game to the next level. Importance of money management. It is essential to have an understanding of the reasons behind the significance of money management, as it is one of the most essential aspects of personal finance. The fact of the matter is that money plays a significant part in all of our lives. Our ability to live the life we want, to purchase the things we need, and to pursue our dreams is hampered as a result. For this reason, it is of the utmost importance to take charge of our financial situation and make prudent decisions regarding our money. Managing one's finances effectively is essential for a variety of reasons, including the following. It assists us in living with our financial means. We are able to ensure that we are not overspending and that we are living within our means by establishing a budget and keeping track of our expenditures. It is beneficial to us in reaching our objectives. It doesn't matter if our financial goals are to purchase a home, save for retirement, or take a trip around the world. Having a solid plan for managing our money is essential to our success in reaching those goals. It enables us to stay out of debt. The ability to live within our means, refrain from overspending, and pay down debt are all aspects of good money management that can assist us in avoiding going into excessive debt. It assists us in getting ready for unexpected events. Unanticipated calamities befall each and every one of us, but being prepared for them with a robust emergency fund can help us weather the storm and stay out of debt. It contributes to the growth of our wealth. The key to effective financial management is learning to make informed choices, and one of the most effective ways to amass wealth is to spend less than we earn, put money away regularly, and wisely invest this money. Effective management of one's financial resources is an essential component of personal finance. It is imperative that we take charge of our financial situation and make informed choices that will assist us in accomplishing our monetary objectives and achieving the lifestyle that we envision for ourselves. Overview of the guide. This all-encompassing guide is intended to assist you in regaining control of your financial situation and accumulating wealth. This manual contains a total of 20 chapters, each of which is dedicated to a distinct facet of one's personal financial situation. The first few chapters will provide an overview of the fundamentals of personal finance, including the formulation of financial objectives, the formulation of a budget, the monitoring of expenses, and the administration of debt. After that, we will move on to more advanced topics such as investing, planning for retirement, and managing taxes. In addition, we will discuss the significance of safeguarding your assets with insurance, establishing an emergency fund, and making the most of the income that you have available to you. In addition to this, we will discuss the best ways to handle your family's money as a couple and how to educate your children on the subject of financial responsibility. At the conclusion of this guide, you will have an in-depth comprehension of personal finance as well as the tools and the knowledge you require to achieve your financial goals and build wealth. It doesn't matter if you're just getting started with your personal finance journey or if you're looking to take your personal finance game to the next level. Master Your Money has got you covered either way. Chapter 1. Understanding Your Finances. Assessing your current financial status. Before you can begin making changes to your financial situation, you need to have a solid understanding of where you currently stand. Because of this, the first thing you need to do in order to manage your money is to evaluate your current financial situation. In this chapter, we will focus on developing a comprehensive understanding of your income, expenses, assets, and liabilities, as well as your net worth. It might look intimidating, but you shouldn't be scared of it. The objective here is to simply gather all of the information you require so that you can make educated decisions regarding your finances. The following is a rundown of the most important steps to take when evaluating your current financial situation. Keep tabs on your revenue. First things first, make a list of all the ways in which you get money, such as your salary, any bonuses you get, investment income, and any other resources. Keeping tabs on your expenditures is the next step. You should begin by compiling a list of all your monthly costs, such as those associated with housing, food, transportation, entertainment, and any other costs. Determine your net worth. If you want to get a complete picture of your current financial situation, determining your net worth is an important step to take. This can be determined by deducting your obligations or debts from the values of your assets, savings, investments, and property. Conduct a thorough examination of your spending patterns. Once you have a comprehensive picture of your income and expenses, the next step is to conduct an in-depth examination of your spending patterns. Are there any areas in which you are spending more than necessary? Are there any costs that you could reduce to save money? You will have a crystal clear understanding of your current financial situation, and you will be prepared to begin making changes that will assist you in achieving your monetary objectives. So let's get started. Setting financial goals. Following an analysis of your current financial situation, the next step is to formulate some financial objectives for the future. In this chapter, we will discuss how to determine what it is you hope to accomplish with your financial resources and how to devise a plan to get there, because it provides you with both direction and motivation. Setting financial goals is an essential step in the process of managing your money. When you have a clear goal in mind of your financial future, it is much simpler to make decisions that are in your best interest financially. The following is a guide for establishing financial goals. Determine the goals that you want to accomplish. You should begin by asking yourself what you want to accomplish with the money you have. Do you have goals such as saving for retirement, purchasing a home, getting rid of debt, or traveling the world? Put your objectives in writing and try to be as specific as you can. Make sure your goals are measurable. In order to monitor your development accurately, your objectives ought to be quantifiable and specific. Saying something like, I want to save more money, isn't as specific as saying something like, I want to save $10,000 in the next year. Put a practical spin on your aspirations. Your goals ought to be difficult to achieve, but not impossible. Do not invite your own failure by establishing standards that are impossible to meet. Put a time limit on each of your goals, and hold yourself accountable to that time limit. This will assist you in maintaining your focus and will keep you motivated. Understanding your income and expenses. Following the completion of an analysis of your current financial situation and the formulation of your financial objectives, the next step is to conduct a more in-depth investigation of your income and expenditures. This chapter is all about taking control of your finances and making sure that your income and expenses are in line with the things you want to accomplish by the end of the book. The following is an outline of the most important steps to take in order to comprehend your income and expenditures. Establish a budget. To get started, you need to establish a budget that accurately reflects both your income and your expenses. This will assist you in understanding precisely where your money is going and pointing out areas in which you can make reductions. Maintain an accurate record of all your expenditures, no matter how insignificant they may seem. This will provide you with an accurate depiction on where your money is being spent and assist you in locating areas in which you can make reductions. Look for opportunities to boost your income in addition to keeping track of your expenditures. It is also essential to search for job opportunities to boost your income. This could mean asking for a raise at your current job, beginning a second job on the side, or finding other ways to increase your earning potential. Review and make necessary adjustments to your budget on a regular basis because both your income and your expenses are subject to change over time. It is essential to review and make necessary adjustments to your budget on a regular basis. This will assist you in maintaining your forward momentum and achieving your monetary objectives. Chapter 2. Creating a Budget. Types of budgets. Managing your money effectively requires a number of steps, one of the most important of which is developing a budget. But were you aware that there are many distinct formats for budgets that people can use? In this chapter, you will learn about the various types of budgets as well as how to determine which budget works best for you. The following are some examples of the most common kinds of budgets. A budget using envelopes is a type of budget that is modeled after the more conventional envelope system. You will put some cash aside for each type of expense, such as housing, transportation, and food, and you will only spend the amount that is in the corresponding envelope. A budget with a starting point of 0 is one in which your monthly income and expenses are in line with one another, giving you a net balance of 0 at the end of the month. If you are using this kind of budget, you are required to assign each and every dollar of your income to a distinct category. 50-30-20 budget. The 50-30-20 budget is a simple and effective budget that divides your income into 3 categories: 50% for the necessities, 30% for wants, and 20% for saving and debt repayment. The 50-30-20 budget is a simple and effective budget. Flexible budget. A flexible budget allows for some wiggling room in your spending. People who prefer a more laid-back approach to budgeting, as well as those who have unpredictable income or expenditures, will find that this type of budget is the most suitable for their needs. Setting a budget. It is time for you to start creating your own budget now that you have a better understanding of the various kinds of budgets. This chapter is all about putting your budget into action and incorporating it into your day-to-day life so that it becomes second nature. Creating a budget can be done as follows. Find out how much money you make. You should begin by calculating your monthly income, which should include the money you make from your regular job, any side jobs you have, and any other sources of income. Keeping tabs on your spending is essential, so make it a point to do so for at least one full month. This will provide you with an accurate depiction of where your money is being spent and assist you in locating areas in which you can make reductions. Categorize your expenses. Create subcategories for each of your outgoing costs, such as housing, food, transportation, and entertainment. Depending on your income and your expenses, divide up your available funds among the various categories of your budget. Be sure that you are putting your needs first and setting aside money for your long-term goals. Maintain financial discipline by adhering to the budget that you've established. Maintaining your commitment to your budget, despite the fact that this may require some alterations along the way, will assist you in achieving your monetary goals. Sticking to a budget. Creating a budget is the easy part. Actually sticking to it is the challenge. This chapter is dedicated to teaching you how to make sticking to your budget a habit and prevent it from becoming an afterthought. Here are some tips for sticking to a budget. Maintain a reasonable attitude and ensure that your financial plan is reasonable. Take into account your lifestyle as well as your outgoing costs. You are more likely to get off track if the requirements are too stringent. Maintain a close eye on your spending. If you maintain a close eye on your spending, you will be able to maintain control of your budget and identify areas in which you can make reductions. Look for ways to save. If you want to save money, look for ways to do so, such as reducing the amount you spend on entertainment or searching for deals and coupons. Put your savings on autopilot by establishing recurring transactions from your checking account to your savings account. This will assist you in meeting your long-term financial objectives. Maintain your motivation by surrounding yourself with encouraging people, such as friends and family members who are on board with your plans for your finances, and rewarding yourself when you successfully adhere to your financial plan. Chapter 3. Saving Money. Setting up a savings plan. The ability to save money is an essential part of managing personal finances, and having a strategy in place to do so can assist you in achieving your monetary objectives. This chapter is all about how to create a savings plan that is tailored to your specific needs and goals. Here are some tips for setting up a savings plan. First things first, before you even begin to save, you need to decide what it is you're putting that money away for. This could be a savings account for unexpected expenses, a down payment on a future vacation, or even a down payment on a house. Keeping a distinct objective in mind will help you maintain your motivation. Once you have an idea of what you want to accomplish, the next step is to determine how much money you can put away each month to work towards achieving those goals. This sum ought to be reasonable and within your financial plan. Make saving a habit by setting up automatic transfers from your checking account to your savings account. This will help you save money without thinking about it. This will help you reach your goals more quickly and make it easier for you to save money. Pick the right savings account. Pick a savings account that provides you with both a high interest rate and easy access to your money whenever you need it. To assist your savings in developing at a more rapid rate, you might also want to think about opening a certificate of deposit or a high-yield savings account. Keep track of your progress. Be sure to keep track of your progress on a regular basis and make any necessary adjustments to your savings plan. This will assist you in maintaining your current course and achieving your goals more quickly. Finding money to save. Putting money away for the future can be difficult, particularly if you are living from paycheck to paycheck. However, if you are willing to put in a little bit of effort, you can save money and achieve your monetary objectives. The topic of this chapter is how to put money away for the future. Here are some suggestions for accumulating saving funds. Reduce your expenditures. Investigate areas in which you can reduce your expenditures, such as dining out, going out to entertainment, or paying for subscriptions. Every little bit helps to get you closer to your objectives, and you can put every dollar you save towards accomplishing those objectives. Make some extra money. If you want to make some extra money, you should think about doing some freelance work or starting a side business. Your regular income and the amount of money you can put away each month both increase as a result of this. Negotiate your bills. Make sure you give yourself enough time to negotiate your monthly bills and other expenses such as your rent, your utilities, and your insurance. It's possible that you could find ways to cut down on your regular expenses and put away more cash. Utilize cashback apps and websites. Utilizing cashback apps and websites allows you to earn money back on purchases that you are already making. There is no need to alter your typical spending behavior in order to benefit from this simple method of saving money. Use your imagination. Use your imagination and come up with original ways to cut costs, such as sharing a car or growing some of your own food. The more you are able to reduce your costs, the more money you will have available for savings. Types of savings accounts. When it comes to money management and working towards your financial objectives, one of the most important steps is opening a savings account. The availability of a dizzying number of distinct kinds of savings accounts, on the other hand, can make it difficult to select the most suitable one. This chapter will discuss the various kinds of saving accounts that are available, as well as the criteria you should use to select the account that is most suitable for your circumstances. The following are some examples of the most common kinds of savings accounts. The traditional savings account is the most fundamental kind of savings account, and the vast majority of financial institutions offer it to their customers. It will typically provide you with a low rate of interest and simple access to your funds. The interest rate on a high-yield savings account is typically higher than the rate offered by a conventional savings account. If you want to earn more money off of your savings, then you should consider opening this kind of account. A certificate of deposit, also known as a CD, is a specific kind of savings account that guarantees a particular rate of interest for a predetermined amount of time. CDs typically come with interest rates that are higher than those offered by standard savings accounts. However, if you withdraw your money before the term is up, you may be subject to a penalty. Money market account. A money market account is a type of savings account that, in comparison to conventional savings accounts, typically provide access to interest rates that are higher and withdrawal options that are more adaptable. The term online savings account refers to a specific kind of savings account that is made available by online financial institutions. The interest rate on these accounts is typically higher than the rate offered by traditional savings accounts, and the fees associated with these accounts may be lower. When selecting a savings account, it is important to take into consideration your savings goals as well as your monthly budget and the interest rate. If you choose the right kind of savings account, you can increase the amount of money you earn on your savings and achieve your monetary objectives more quickly. Chapter 4. Investing. Types of investments. Putting your money to work for you in form of investments is a crucial action to take on the path to achieving your long-term financial objectives. The fact that there is such a wide variety of possible investments, however, can make it difficult to select the most appropriate one. The purpose of this chapter is to provide an overview of the various opportunities for financial investment, as well as guidance on how to select the option that is most suitable to an individual's specific circumstances. The following is a list of some of the most common kinds of investments. Stocks are a form of investment that can be thought of as a representation of ownership in a company. When you buy a share of a stock in a company, you are effectively purchasing a fractional ownership stake in that business and becoming a shareholder. The value of an investor's portfolio can fluctuate wildly, but over the course of a longer period of time, stocks have the potential to generate significant returns. Bonds. Bonds are a type of investment that represent a loan made to a company or government. Bonds can be purchased by an individual. When you buy a bond, you are essentially lending the issuer money and will receive interest payments on a regular basis in return for your investment. Although bonds are generally considered to be a safer investment than stocks, the potential returns that can be earned from bonds are also lower. Investing in real estate can be accomplished in a number of ways, including buying a property with the intention of renting it out, purchasing shares in a real estate investment trust, or trading houses. Investing in real estate can be a fantastic way to build wealth, but doing so involves taking on a number of risks and making a significant initial investment. Mutual funds. Mutual funds are a type of investment that pool the capital contributed by numerous investors in order to acquire a diversified portfolio of stocks, bonds, and other types of securities. Mutual funds are a great way to get your feet wet in the world of investing and diversify your holdings, but you should be aware that investing in them will cost you money and that they may carry a higher level of risk than other types of investments. Exchange-traded funds. ETFs are investments that are comparable to mutual funds. However, they are traded on an exchange in the same manner as stocks. ETFs provide an easy and convenient way to invest in a diversified portfolio of securities, and they can be a good choice for investors who want to focus their investments in a particular market or industry. The term cryptocurrency refers to a form of digital currency that uses various encryption methods to ensure the safety of financial transactions. Cryptocurrency can be a speculative investment and has the potential for high returns. However, it is also highly volatile and is not widely accepted as a form of payment. Despite these factors, however, investors may find it attractive to make such an investment. When selecting an investment, it is important to take your financial goals, level of comfort with risk, and time horizon for the investment into consideration. Before settling on a choice regarding an investment, it is essential to carry out adequate research and gain an understanding of the possible drawbacks and benefits associated with each option. You can lower your overall risk and improve your chances of achieving your financial goals by diversifying the types of investments you hold in your portfolio. Understanding investment risk. Investing inherently involves some degree of risk, and before committing any money to a particular investment, you should have a solid understanding of the various forms of risk that are associated with that investment. In this chapter, we'll delve deeper into the concept of investment risk and discuss some effective strategies for mitigating it. Changing the value of your investments can expose you to the possibility of incurring financial losses or failing to meet your long-term financial objectives. This is what is meant by the term investment risk. It is essential to have solid understanding that any and all investments are subject to some degree of risk, and that the possibility of higher returns is typically accompanied by a higher degree of risk. There are a number of distinct types of investment risk, the most common of which are market risk, credit risk, and inflation risk. The possibility of incurring financial losses as a result of shifts in the market, such as falls in the price of stocks, is what is meant by the term of market risk. Credit risk is the potential for monetary loss as a result of shifts in the creditworthiness of a borrower, such as when a business fails to make payments on a bond that it has issued. The possibility of experiencing a decline in one's purchasing power as a direct result of inflation over a period of time is what is meant by the term inflation risk. Managing investment risk. Diversification is essential to effectively managing the risk of investments. You can lessen the impact of market downturns and protect your portfolio from experiencing extreme losses if you diversify your investments across a variety of asset classes, such as stocks, bonds, and real estate. You should also make it a habit to review and rebalance your investment portfolio on a regular basis to ensure that it continues to reflect your financial objectives and comfort level with risk. Recognizing your personal tolerance for risk is an essential part of effectively managing investment risk. While some investors are more willing to take risks in exchange for the possibility of higher returns, others favor investments that are less risky so that they can keep more of their initial investment. It is essential to select investments that correspond with the level of risk you are willing to accept. This will allow you to feel at ease with the level of risk you are assuming. When it comes to making decisions about investments, investment risk is an essential component to take into account. However, if you have a portfolio that is sufficiently diversified and a firm grasp on the level of risk you are willing to take, you can reduce your exposure to investment risk and boost the likelihood of achieving your monetary objectives. Building an investment portfolio. When you're just starting out in the world of finance, putting together an investment portfolio may seem like an overwhelming task, but it's an essential step towards reaching your financial goals. In this chapter, we'll simplify the process of constructing an investment portfolio by breaking it down into steps that are easy to follow and manage. Determine your investment objectives. It is important to determine the investment objectives before beginning the process of building your portfolio. This includes determining the level of financial risk that you are comfortable with taking on, as well as identifying your long-term financial goals such as retirement or a down payment on a home. Pick your investments. You have a wide variety of options to pick from when it comes to investments, including stocks, bonds, mutual funds, and exchange-traded funds, among many others. It is essential to choose investments that are compatible with your investment goals and the amount of risk you are willing to take. Diversify your investments. To reduce the amount of risk you take on with your money and to increase the amount of return you get, diversification of your portfolio is essential. This entails diversifying the type of assets in which you invest, such as stocks, bonds, and real estates, as well as the businesses in which you invest and the regions in which you do so. Review and rebalance. Review and rebalance your portfolio on a regular basis. The practice of reviewing and rebalancing your investment portfolio on a regular basis is an essential component of the upkeep of a diversified investment portfolio. This involves making sure that your investments are still in line with your investment goals and the amount of risk you are willing to take, as well as making any necessary adjustments. Building an investment portfolio may appear to be an overwhelming task. However, if you take it one step at a time and adhere to these straightforward guidelines, you will be able to build a portfolio that will assist you in achieving your financial goals while reducing the amount of investment risk that you are exposed to. Chapter 5. Credit. Understanding credit scores. When you're just starting out in the world of finance, putting together an investment portfolio may seem like an overwhelming task, but it's an essential step towards reaching your financial goals. In this chapter, we'll simplify the process of constructing an investment portfolio by breaking it down into steps that are easy to follow and manage. Determine your investment objectives. It is important to determine your investment objectives before beginning the process of building your portfolio. This includes determining the level of financial risk that you are comfortable with taking on, as well as identifying your long-term financial goals, such as retirement or a down payment on a home. Pick your investments. You have a wide variety of options to pick from when it comes to investments, including stocks, bonds, mutual funds, and exchange-traded funds, among many others. It is essential to choose investments that are compatible with your investment goals and the amount of risk you are willing to take. Diversify your investments. To reduce the amount of risk you take on with your money and to increase the amount of return you get, diversification of your portfolio is essential. This entails diversifying the types of assets in which you invest, such as stocks, bonds, and real estate, as well as the businesses in which you invest and the regions in which you do so. Review and rebalance your portfolio on a regular basis. The practice of reviewing and rebalancing your investment portfolio on a regular basis is an essential component of the upkeep of a diversified investment portfolio. This involves making sure that your investments are still in line with your investment goals and the amount of risk you are willing to take, as well as making any necessary adjustments. Building an investment portfolio may appear to be an overwhelming task. However, if you take it one step at a time and adhere to these straightforward guidelines, you will be able to build a portfolio that will assist you in achieving your financial goals while reducing the amount of investment risk you are exposed to. Building and maintaining good credit. It is important to have good credit for many aspects of your financial life, including getting approved for loans, credit cards, and mortgages, as well as securing lower interest rates and fees. Having good credit can help you with all these things. In this chapter, we will discuss the steps you can take to build and maintain good credit, so that you can take advantage of the many benefits that come along with having a high credit score. These steps include paying bills on time, maintaining a positive balance, and avoiding late payments. Creating a credit history. If you've never used credit before, the first thing you should do is create a credit history. This can be accomplished by submitting an application for a credit card or a loan and ensuring that your payments are made on time. Making wise use of credit cards. If you make responsible use of credit cards, they can be an excellent tool for establishing or improving your credit score. This involves not going overboard with your spending, paying off your balance in full every month, and maintaining a low percentage of your available credit. Monitoring your credit report. One of the most important aspects of keeping good credit is maintaining a regular monitoring schedule for your credit report. This will assist you in identifying any errors or indications of fraud that may be present on your credit card reports and will ensure that the information is correct. It is extremely important to pay your bills on time because your payment history is one of the most important factors in determining your credit score. This encompasses everything from payments for loans and credit cards to payments for utilities and other necessities. Paying down debt. As a high level of debt can have a negative impact on your credit score, it is important to pay down as much of your debt as you can. This includes paying off balances on credit cards and other forms of debt, such as personal loans and other types of loans. The process of establishing and maintaining positive credit takes time and effort, but the rewards are well worth the investment. If you have a good credit score, you will be able to take advantage of more financial opportunities, pay lower interest rates, and obtain credit more easily. You can establish and keep good credit by adhering to these straightforward steps, and you'll be able to take advantage of the many advantages that come with having a solid financial foundation. Dealing with credit card debt. When it comes to paying off credit card debt, it can be challenging to know where to begin. Credit card debt is a common problem and many people struggle with it. In the following chapter, we will discuss the actions you can take to regain control of your credit card debt and take the first step towards achieving monetary independence. Determine the extent of the problem. The first thing you should do when dealing with the credit card debt is determining the scope of the problem. Create a list detailing the balances, interest rates, and the minimum payments for each of your credit cards. You will gain a better understanding of exactly how much debt you are dealing with and where to begin as a result of reading this. Set your debt payoff priorities. Once you have determined the total amount of your debt, the next step is to establish which of your credit cards should be paid off first. It's possible that you should begin with the credit card that has the highest interest rate, but you could also begin with the card that has the lowest balance. Make a budget. If you want to get out from under your credit card debt, you're going to need to make a budget. This will assist you in determining areas in which you can reduce spending so that you can put more money towards paying off your debt. Consider enrolling in a debt management program. If you're having trouble paying off your debt on your own, you should think about enrolling in a debt management program. It is a repayment plan that assists you in paying off your debt over a period of time, usually ranging from 3 to 5 years. Negotiate with your creditors. If you are still having trouble meeting all of your financial obligations, you should give some thought to negotiating with your creditors. They might be willing to negotiate a debt settlement with you, lower your interest rates, or reduce the amount of the minimum payment you have to make each month. You should make every effort to stay out of financial trouble in the future, particularly after you have paid off the balance on your credit cards. This requires you to stick to your budget, use credit cards only in cases of extreme necessity, and refrain from spending more than you have. Dealing with debt from credit cards can be a challenging and stressful process. However, it is essential to keep in mind that there is always a way out of this predicament. You will be able to regain control of your debt, pay it off, and move on to a more secure and prosperous financial future if you follow these steps. Chapter 6. Insurance. Types of insurance. When it comes to managing your finances and protecting both yourself and your assets from unforeseen circumstances, insurance should be a priority for you. In this chapter, we will discuss the various types of insurance that can be obtained as well as the factors that contribute to their significance. Insurance for your health is one of the most crucial forms of protection that you can purchase for yourself and your loved ones. It contributes to the cost of medical care, which may include visits to the doctor, stays in the hospital, and the purchase of prescription medication. If you don't have health insurance, a serious injury or illness could put you in the poorhouse financially. Life insurance. The purpose of life insurance is to offer financial protection to a person's loved ones in the event that the insured person passes away before them. This kind of insurance can help cover expenses such as funeral costs, unpaid debts, and living expenses for your family members who are left behind after you pass away. Insurance against disabilities. Having disability insurance protects your financial well-being in the event you become disabled or are unable to continue working. If you become unable to work for any reason, having this kind of insurance can help you cover the costs of your living expenses and other bills. Homeowners insurance. Homeowners insurance is a type of insurance that offers monetary protection for your home as well as all your personal belongings in the event of a covered loss. In the event that your home is damaged as a result of an event that is covered by the policy, such as a fire or theft, it may help cover the costs of repairing or rebuilding your home. Auto insurance. Auto insurance provides financial protection for your vehicle as well as for any damage or injury that you may cause to others while operating your vehicle. This includes compensation for any medical expenses that may be incurred as a result of those injuries. This particular kind of insurance is mandated by law in the majority of states and is essential for ensuring both your own safety and the safety of others while driving. Umbrella insurance. Umbrella insurance is a type of coverage that offers additional protection on top of and in addition to the coverage that is provided by your other insurance policies. In the event that you are sued or suffer some other kind of significant financial loss, having this kind of insurance can help protect your assets. Insurance for long-term care. Long-term care insurance offers financial protection against costs of long-term care, such as those incurred by nursing home care or in-home care provided by a caregiver. As you get older, having this kind of insurance can help you keep your independence and preserve your quality of life. When it comes to protecting yourself and your assets from unforeseen calamities, having the appropriate insurance coverage is absolutely necessary. By gaining an understanding of the various kinds of insurance policies that you are offered, you will be willing to make decisions that are well informed and ensure that you have the necessary protection. Evaluating insurance needs. It is essential to assess your requirements for insurance on a regular basis in order to guarantee that you have the appropriate level of coverage for your requirements. In this chapter, we will discuss how to evaluate your requirements for insurance and make adjustments to your coverage based on those requirements. Your first order of business when determining what kind of insurance coverage you require is to take stock of the dangers you're exposed to. This involves taking into account a variety of factors, including your age, health, occupation, and the assets you need to safeguard. After you have performed a risk assessment, it is imperative that you review the coverage that you currently have with your insurance providers. Take a close look at different types of coverage you currently possess and ask yourself if they continue to meet all of your requirements. Determine your coverage needs. You can determine what additional coverage you might require by looking at the risks you face and the protections you already have in place. For instance, if you have a job that carries a high risk of injury, you might want to look into purchasing additional disability insurance. When determining what kind of insurance you require, one of the most important factors to take into account is your financial situation. You should make sure that you have sufficient coverage to protect both yourself and your assets, but you should also think about how much you can afford to pay each month for your premiums. Do your research. Don't be afraid to do your research and compare the various insurance policies offered by various companies. It's possible that you can find a policy that offers better protection at a price that's more affordable. Review on a regular basis. As a final point of consideration, you should make sure that your insurance requirements are reviewed on a regular basis. Your requirements for insurance might shift as a direct result of the changes occurring in your life. For instance, if you just had a baby, you might want to consider increasing the amount of life insurance coverage you have. It is essential to your financial management to conduct regular reviews of the types and amounts of coverage you require from your various insurance policies. You can ensure that you will have the protection you require when you have a need for it if you take the time to evaluate the risks you face and determine the types of coverage you require. Choosing the right insurance coverage. There was a young couple who went by the names of John and Sarah once upon a time. They had recently begun their professional lives and were excited to begin laying the groundwork for their financial security. They were aware that ensuring that they had adequate insurance coverage was an essential component of their overall financial strategy. They finally got around to meeting with a financial advisor to talk about their requirements for insurance one day. The consultant took the time to walk them through the numerous options for insurance protection, such as long-term car insurance, health insurance, life insurance, disability insurance, homeowners insurance, auto insurance, umbrella insurance, and more. John and Sarah were feeling a little overloaded by all of the information, but the advisor guided them through the process of comprehending the significance of the various kinds of insurance and the coverage that was appropriate for them. They came to the conclusion that they needed health insurance to cover their medical expenses, life insurance to provide financial protection for their loved ones in the event that they passed away, and homeowners insurance to protect their home and their personal property from damage. John and Sarah came to the conclusion that it would be in their best interest to invest in insurance coverage that was individualized to their particular requirements. They were certain that the actions they had taken to safeguard their financial future were the best ones to take. After some time had passed, John was involved in a car accident that rendered him unable to continue working. He was fortunate enough to have disability insurance coverage, which allowed him to continue earning money even while he was recovering from his injury. Sarah was also thankful that they had life insurance because she had the peace of mind of knowing that their loved ones would be provided for in the event that something tragic occurred to either of them. John and Sarah carried on with the process of building their financial future, and they were grateful for the sense of security that was afforded to them by the insurance coverage they had. They were confident that they had selected the appropriate insurance coverage for themselves and their requirements, and that this was the decision that they should have made. And that wraps up the tale of how John and Sarah came to understand the significance of picking the appropriate level of insurance coverage for their needs. They were protected and had taken the necessary steps to ensure that their financial future was secured, so they lived happily ever after, knowing that they had done everything they needed to. Chapter 7. Retirement Planning. Understanding Retirement Accounts. We all look forward with excitement to the significant life event that is retirement. However, this stage of life can also be marked by significant financial unpredictability. It is imperative that you initiate a savings plan as soon as you can if you want to guarantee that you will have sufficient funds to live comfortably during your retirement years. The use of retirement accounts, which are distinct savings accounts that have been specifically designed to assist you in accumulating a nest egg for your later years of life, is one method for accomplishing this goal. There is a wide variety of options available to choose from when it comes to retirement accounts, each of which comes with its own specific rules and advantages. One possibility is that your employer provides you with a 401k account, to which you can contribute a certain amount of money from your paycheck on a regular basis. Because the savings are deducted from your paycheck on a regular basis, this strategy makes it easy to put money aside for your retirement. Additionally, many employers offer matching contributions, which means that you'll be able to save even more money for your future by taking advantage of this benefit. Individual retirement accounts, or IRAs, are yet another variety of savings accounts for your retirement. IRAs provide you with a greater degree of control of your investments and enable you to select from a more extensive pool of investment opportunities. An individual who is self-employed or does not have access to a 401k plan can benefit greatly from opening an individual retirement account because it allows for contributions to be made even in the absence of an employer-sponsored plan. It is essential to have a solid understanding of the specific parameters that govern retirement accounts, including the maximum annual contribution amount, the window of time during which funds may be withdrawn, and the types of investments permitted with those funds. For instance, there is a yearly cap on the amount of money that can be contributed to a 401k or an IRA, and there may be a penalty if you withdraw money from one of these accounts before you reach the age of retirement. But despite these limitations, there are still significant advantages to putting money into a retirement account rather than other types of savings. By setting some of your income aside on a regular basis, you will be able to amass a nest egg that will enable you to maintain a certain level of income once you have reached the retirement age. In addition to this, you'll have the satisfaction of knowing that you've done everything in your power to safeguard your financial future. It is never too late to start saving for your retirement, regardless of whether you are just beginning your career or are a seasoned professional. Saving for retirement can be started at any time. You will be able to ensure that you will have the financial resources you require to be able to enjoy your golden years without the worry of not having enough money if you make use of the benefits that are offered by retirement accounts. Estimating retirement needs. Calculating how much money you will need in retirement is an essential part of making preparations for your financial future. This is due to the fact that it assists you in calculating how much money you will need to have saved up by the time you retire in order to be able to live comfortably for the remainder of your life. In order to determine how much money you'll need for retirement, you will need to take into account a number of factors, such as your current way of life, the amount of money you anticipate spending during retirement, and the number of years you anticipate spending in retirement. For instance, if you want to retire comfortably and still have enough money left over for traveling or hobbies that require significant outlays of cash, you should include those costs in your retirement plan. Utilizing a retirement calculator is among the most effective methods of determining how much money you will require during retirement. These calculators take a variety of considerations into account, including things like your current salary, when you anticipate retiring, and the amount of money you anticipate spending in retirement. After that, they will give you an estimate of how much money you will need to have saved up in order to retire in comfort. It is essential to keep in mind that your requirements for retirement may shift over the course of your lifetime, and as a result, you will want to reevaluate them on a regular basis. For instance, if you experience a significant life event such as the birth of a child or the change of a job, you will want to adjust your retirement plan to account for the additional costs that come along with the event. When calculating how much money you'll need in retirement, the impact of inflation is another crucial factor to take into account. When determining how much money you will need during retirement, it is essential to take into account the average annual rate of inflation. This is because the cost of living has a tendency to rise over time. Determining how much money you will need in retirement is an essential step in the process of developing a sound financial plan for your future. You will be able to ensure that you have the financial resources necessary to enjoy a comfortable retirement if you take the time to understand your expenses, your retirement goals, and the impact that inflation will have on your retirement savings. Building a retirement savings plan. Putting together a saving strategy for retirement is absolutely necessary if one wishes to have a secure financial future. If you start putting money away for your retirement at an earlier age, it will be much simpler to accomplish your objectives and your retirement will be much more enjoyable. To get things rolling, here is the information you need to know. Determine your objectives. Before you start saving for your retirement, you need to know how much you'll need to save and what you want to do with the money you've set aside for that purpose. Think about things like the costs you anticipate incurring and the kind of lifestyle you envision for yourself and any future plans you may have. Evaluate your current financial situation. Consider your current level of debt as well as your income and expenses in order to get an accurate picture of how much money you can reasonably put away for your retirement each month. Take into consideration the following. There are numerous options for savings for retirement, such as individual retirement accounts, employer-sponsored retirement plans, and annuities. All of these options are available to consumers. Because each choice brings its own set of advantages to the table, it is essential to do some investigation into the available alternatives before making a final decision. Start putting money away. Once you've calculated how much of your income you can reasonably put away on a monthly basis, you should begin making deposits into your retirement savings plan. Contributions of any size, when added up over time, can have a significant impact on a person's ability to provide for themselves in the future. Raise the amount you contribute over time. If your income rises over time, you should give some thought to the possibility of raising the amount you pay into your retirement savings plan. This will make it easier for you to achieve your goals more quickly and will ensure that you will have the resources you require when you retire. Maintain your momentum. Make it a habit to review your retirement plan on a regular basis and make any necessary adjustments to ensure that you are on track to achieve your objectives. Think about enlisting the assistance of a financial advisor if you want to get the most out of your money that you've set aside for your retirement. Establishing a saving strategy for retirement is an essential step in the process of securing your financial future. You will be able to construct a plan that not only satisfies your requirements, but also assists you in reaching your retirement objectives if you take the time to assess not only your objectives, but also your current financial standings and your available choices. Chapter 8. Tax planning. Understanding tax laws and regulations. It is essential to your ability to manage your personal finances to have a solid understanding of the rules and regulations pertaining to taxes. Your income and expenses, as well as your investment and insurance coverage, are all impacted in some way or another by taxes. In order to make the most of your financial situation and reduce the amount of money you have to pay in taxes, here is what you need to know. Get familiar with the tax code. Maintain a current awareness of the most recent tax laws and regulations, including any changes that may have been made to the applicable tax rates, deductions, and credits. Because of this, you will be able to make educated decisions about your finances and steer clear of costly errors. Maintain complete and accurate records. You need to keep detailed records of all your income and expenses, including copies of all your receipts, invoices, and bank statements. This will assist you in accurately filing your taxes and support any deductions or credits that you claim to be eligible for. Make use of tax breaks such as deductions and credits. Make the most of deductions and credits that are available to you, such as those for charitable donations, mortgage interest, and expenses related to your business. Prepare your budget taking into consideration the applicable taxes. Take into account the potential tax repercussions of the decisions you make regarding your finances, such as selecting amongst various options for investments or insurance coverage. Consider working with a tax professional or financial advisor if you are unsure about the tax implications of your finances or if you need assistance with your taxes. If you are unsure about the tax implications of your finances, you should seek professional assistance. Having a solid grasp on the applicable tax laws and regulations is an essential component of effective personal financial management. You can reduce the amount of money you have to pay in taxes and improve your financial stability if you educate yourself, keep detailed records, and claim all of the deductions and credits to which you are entitled. Minimizing tax liabilities. Managing your personal finances effectively requires that you take steps to reduce your potential tax obligations. The following is a list of potential approaches to lowering your tax liability. Make a careful and calculated plan for your finances. Tax considerations should be taken into account when making financial decisions, such as selecting among various options for investments or insurance coverage. Make use of tax breaks such as deductions and credits. Make the most of the deductions and credits that are available to you, such as those for charitable donations, mortgage interests, and expenses related to your business. Think about using tax-advantaged accounts. If you want to lower the amount of income that is subject to taxation and build up your savings at the same time, you might want to think about using tax-advantaged accounts, such as individual retirement accounts or health savings accounts. Consider timing your investments and other financial decisions around tax laws and regulations, such as selling investments that have lost value or deferring income to a future year. This will allow you to get the most out of your money and minimize your tax liability. Consider working with a tax professional or finance advisor if you are unsure about the tax implications of your finances or if you need assistance with your taxes. If you are unsure about the tax implications of your finances, you should seek professional assistance. Reducing the amount of money you owe in taxes is an essential component of effective management of your personal finances. You can minimize your tax liability and improve your financial standing by employing strategic financial planning, making use of available deductions and credits, and getting assistance from a qualified professional. Planning for tax-efficient investments. Managing your personal finances should always include making plans for investments that minimize their tax impact. The following is a list of some strategies that can help you reduce the impact of taxes on your investments. Take into consideration tax-advantaged accounts. Tax-advantaged accounts, such as individual retirement accounts and health savings accounts, can provide tax benefits that can reduce your taxable income and help you build your savings at the same time. Choose investments that are tax efficient. Certain investments, such as index funds, exchange-traded funds, and municipal bonds, are inherently more tax efficient than others and can help you reduce the amount of tax you owe. Consider timing your investments and other financial decisions around tax laws and regulations, such as selling investments that have lost value or deferring income to a future year. This will allow you to get the most out of your money and minimize your tax liability. Invest in a variety of assets by spreading out your holdings in your portfolio. Not only can this strategy help you reduce the amount of taxes you owe, but but it can also help you reduce the overall risk associated with your investments. Managing your personal finances should always include making plans for investments that minimize their tax impact. You can minimize your tax liability and maximize your investment returns by taking advantage of tax-favored accounts. Selecting investments are tax efficient, making wise decisions regarding your timing and your investments, diversifying your portfolio, and getting help from a financial professional. Chapter 9. Estate Planning. Understanding estate planning. Learning about estate planning is an essential component of effective personal financial management because it enables you to plan for the future and make certain that your possessions are parceled out in accordance with your preferences. In the process of estate planning, you not only prepare for the possibility that you will become unable to care for yourself, but also devise a strategy for the distribution of your assets after your passing. The following is a list of important aspects of estate planning. Putting together a will. A will is a formal document that specifies how you want your property and possessions to be divided up after your death. Wills are required by law. In a will, you can designate an executor to handle the management of your estate, as well as guardians for any children who are still minors. Beneficiary designations are agreements that you make with financial institutions, such as life insurance policies and retirement accounts, to specify who will receive the benefits from these accounts after your death. You can think of beneficiary designations as a sort of will for your accounts. Establishing trusts allow for the management of assets either during your lifetime or after your passing. Trusts can be used for either purpose. They can provide a way to manage assets for the benefits of others, such as minor children or a charity, or they can reduce the amount of money that is paid in taxes and costs associated with the probate process. Taking into consideration power of attorney. The power of attorney is a legal document that, in the event that you are unable to make decisions for yourself, gives another person the authority to do so on your behalf. Getting ready for long-term care is important because as we get older, the likelihood of our needing long-term care rises. The process of estate planning can assist you in getting ready for this possibility by assisting you in understanding your options for long-term care, such as home care, assisted living, or nursing homes, as well as the means by which you can pay for it. Estate planning is an essential component of effective personal financial management that enables you to plan for the future and ensures that your assets are dispersed in accordance with your preferences regarding how they should be used. You can ensure that your wishes are carried out and that your assets are safeguarded by writing a will, naming beneficiaries, establishing trusts, giving some thought to power of attorney, and making plans for long-term care. Creating a will and estate plan. Developing a will and an estate plan is an essential step in the process of managing one's personal finances. Doing so enables you to plan for the future and make certain that your possessions are dispersed in accordance with your preferences. A will is a formal document that specifies how you want your property and possessions to be divided up after your death. Wills are required by law. A will is only one component of a comprehensive estate plan, which may also consist of a variety of other legal documents and business strategies such as trusts, power of attorney, and plans for long-term care. When writing a will, it is essential to point out an executor who will handle the management of your estate and guardians for any children who are under the age of 18. The terms of the will must be carried out by the executor, who is also accountable for carrying out your instructions regarding the distribution of assets and taking care of any legal and financial obligations that may arise. You should also select someone who can be trusted and who has the necessary skills to serve as your executor. Estate planning can include not only the creation of a will, but also the designation of beneficiaries for various financial accounts, such as life insurance policies and retirement accounts. Beneficiary designations are agreements that you make with financial institutions to specify who will receive the benefits from these accounts after your death. You can make these agreements before or after you open an account. Trusts are a useful tool for estate planning because they can be used to manage assets either during your lifetime or after you pass away. They can provide a way to manage assets for the benefits of others, such as minor children or a charity, or they can reduce the amount of money that is paid in taxes and costs associated with the probate process. By establishing a power of attorney, estate planning can also assist you in preparing for the possibility that you'll become unable to make decisions for yourself. This is a legal document that, in the event that you become unable to make decisions for yourself, gives another person the authority to make decisions on your behalf. Finally, estate planning can assist you in preparing for the possibility that you will require long-term care by assisting you in understanding your options for long-term care, such as home care, assisted living, or nursing homes, as well as how to pay for it. This is an important step in preparing for the possibility that you will require long-term care. Developing a will and an estate plan is an essential step in the process of managing one's personal finances. This enables you to plan for the future and make certain that your assets are dispersed in accordance with your preferences. You can ensure that your wishes are carried out and that your assets are safeguarded by writing a will, naming beneficiaries, establishing trusts, giving some thoughts to power of attorney, and making plans for long-term care. Protecting assets with estate planning. The process of protecting assets through estate planning is an essential component of financial planning. This planning can assist in ensuring that your assets are distributed in accordance with your wishes after your passing by helping to ensure that your assets are protected. When you plan your estate, you decide what will happen to your assets, such as your real estate, investments, and personal belongings after you pass away. This is known as estate planning. You can protect your assets and make sure they are distributed according to your wishes with the assistance of a number of different estate planning tools that are available to you. One of these tools is a will, which is a document that is legally binding and outlines how you want your assets to be distributed after your death. This document is known as a will. Trusts are another tool that can be utilized. A trust is a legal arrangement that enables you to place your assets in a separate entity that is then managed by a trustee for the benefit of beneficiaries. Additionally, estate planning can assist you in minimizing the costs associated with the transfer of assets from your estate to the beneficiaries that you have designated. These costs include taxes and fees associated with the probate process. You could, for instance, provide financial support for your beneficiaries after your death by using estate planning strategies such as gifting assets during your lifetime or setting up a life insurance policy. These are both examples of things you could do. In the end, estate planning is an essential component of protecting your assets and ensuring that your financial goals are met even after your passing away because it ensures that your assets will be distributed according to your wishes. Take the time to think about your requirements for estate planning and then speak with a financial advisor or an attorney who specializes in estate planning so that they can assist you in developing a strategy that is tailored to your particular requirements and objectives. Chapter 10: Debt Management. Understanding debt. Understanding debt, despite the fact that it can be a difficult and stressful topic, is necessary for effective management of one's financial resources. Simply put, being in debt means you have borrowed money and are now obligated to repay the principal amount plus any interest and other associated fees over a predetermined amount of time. There is a wide variety of debt, the most common of which are mortgages, followed by auto loans, credit card debt, student loans, and personal loans, to name a few. When it comes to debt, one of the most important things to take into consideration is the interest rate, because the interest rate on your debt is what determines how much you will pay off in total over the course of the loan. It is essential to have a solid understanding of how it operates. Even if the total amount borrowed is the same, a debt with a high interest rate can end up being much more expensive over the course of its repayment than a debt with a low interest rate. When it comes to debt, the term, or the amount of time that will pass before the debt is paid off, is another essential aspect to take into consideration. Although having a loan with a longer term could mean having lower monthly payments, it also means you will pay more in total interest over the course of the loan's lifetime. On the other hand, a shorter term results in higher monthly payments but a lower total interest expense paid over the course of the loan. Finding the right balance between using debt to finance purchases and investments that can help you achieve your financial goals and avoiding debt that can prevent you from achieving your goals is essential to effective debt management. In order to accomplish this, it is necessary to gain an understanding of your debt and make decisions about how to handle it that are based on accurate information. This may involve paying off debts with higher interest rates first, using debt to finance investments that have the potential to generate more income than the cost of the debt, and borrowing no more money than you are able to affordably repay. Managing credit card debt. Because of the ease of which credit card debt can quickly snowball out of control if it is not properly managed, managing credit card debt is an essential component of personal finance. It is important to learn how to manage your credit card debt in order to avoid high interest rates, late fees, and other costs that can make it difficult to get ahead financially. This can be accomplished by understanding how to manage your credit card debt. The following are some steps that can assist you in managing the debt on your credit cards. Create a budget. Create a budget that takes into account all of your income and expenses, and then decide how much of your income will go towards paying down your credit card debt. This will help you determine how much of a monthly payment you are able to afford to make. Paying off the credit card that has the highest interest rate should be a top priority when it comes to paying off debt, because doing so will help you save money in the long run. Payments should be increased. Always try to make additional payments when you can. Even a modest additional payment each month can have a significant impact over the course of the loan's lifetime. Put your credit cards away. If you want to get out from under your debt, you need to put your credit cards away. This will assist you in avoiding the accumulation of additional debt and will make it simpler for you to concentrate on paying off what you already owe. Consider consolidating your debt. If you have multiple credit cards with high balances, you should seriously consider consolidating your debt into one monthly payment that is more manageable for you. This can help simplify the process of repaying your debt and may even result in a reduction of the total amount of interest you have to pay. Keep in mind that paying off your credit card debt is a gradual process and it could take some time before it is completely paid off. You can, however, get out from under your credit card debt and regain control of your financial future if you exercise self-control, have patience, and remain persistent. Chapter 11. Risk Management. Understanding risk. The process of identifying, evaluating, and subsequently mitigating potential risks to the assets and profits of an organization is referred to as risk management. These dangers may manifest themselves in a number of different ways, including monetary unpredictability, legal liabilities, strategic management blunders, accidents, and natural disasters. The purpose of risk management is to lessen the adverse effects that occurrences like these have on an organization's ability to maintain its financial stability and achieve its goals. When it comes to one's own financial situation, effective risk management is of equal significance. It entails evaluating the dangers that could have an effect on your financial stability and taking measures to protect yourself from those dangers. For instance, if you have investments in stocks and bonds, you might be vulnerable to the risk associated with the market. There is a possibility that you could be exposed to risks associated with your health, such as the expense of medical treatment or care for the long term. You might want to think about purchasing insurance or diversifying your investment portfolio in order to lower the impact of these potential negative outcomes. It is essential to have a solid understanding of the limitations of risk management, which, despite their ability to lessen the negative effects of potential financial risk, cannot completely eliminate them. Despite all of your preparation, it is possible that certain events, such as natural disasters or unexpected health problems, will still take place. You can, however, improve your chances of achieving financial stability and success if you have a good understanding of the personal risks you face and if you take steps to mitigate those risks. Protecting against financial risks. Protecting oneself against monetary hazards is an essential component of both personal financial planning and risk management. You can defend yourself and your assets against various financial dangers with the help of a few different strategies, including the following. Increasing your chances of earning a consistent return on your investments and lowering your vulnerability to market fluctuations can be accomplished by diversifying your investment portfolio. Purchasing insurance. Purchasing insurance can assist in protecting you against financial risks associated with your health, your property, and your income. For instance, health insurance can help cover the cost of medical treatment, and life insurance can provide financial support for a person's loved one in the event that the policyholder dies unexpectedly. Putting together an emergency fund. An emergency fund can serve as a source of financial support in the event of unforeseen circumstances, such as the loss of a job, the occurrence of a natural disaster, or the incurrence of unexpected expenses. You can lessen the effect that these occurrences have on your finances if you keep some money put aside in case of emergencies. Paying off debt. Reducing the amount of debt you owe can help you reduce the amount of risk you are exposed to financially. When you have a lot of debt, it raises the possibility that you won't be able to pay back your loans, which can have a negative effect on your credit score. Preparing for retirement. Preparing for retirement and saving for the future are two things that can help ensure that you will have the resources you need to support yourself in your later years. You can improve your chances of achieving financial success and stability if you take measures to defend yourself against potential financial threats. It is essential to conduct regular risk assessments of your personal finances and to take measures to protect yourself from the unidentified threats if you want to realize your financial objectives and ensure a stable financial future. Managing risk with insurance. The effective management of risk through the purchase of insurance is an essential component of personal finance, as this practice serves to protect both you and your assets in the event of unforeseen occurrences. You have a number of options to select from when it comes to insurance policies, and the one you go with should be determined by your requirements as well as your current state of finances. There are many different kinds of insurance, but the most common ones are life insurance, health insurance, car insurance, and homeowners insurance. Every kind of insurance offers protection against a unique set of threats and comes with its own set of benefits and drawbacks. When determining the appropriate amount of insurance coverage for your needs, it is essential to take into account a variety of aspects, including your age, health, income, and the value of your assets. This will assist you in determining how much insurance coverage you require, as well as what kind of insurance policy best suits your needs. For instance, if you are single and in good health, you might only require a modest amount of life insurance coverage. On the other hand, if you are responsible for the financial well-being of a family, you might want to give some thought to purchasing a more all-encompassing plan. When selecting an insurance policy, it is essential to take into account not only the cost of monthly premiums, but also the extent of the protection they offer. Some policies could have higher premiums but provide coverage that is more all-encompassing, while others could have lower premiums but provide coverage that is less extensive. It is important to have a comprehensive insurance plan in place so that you can protect yourself from potential financial risk and ensure that you can do so with a clear mind. It doesn't matter if you're looking for life insurance, health insurance, homeowners insurance, or another kind of insurance. You should always shop around and compare different options before settling on a policy that best suits your needs. Don't forget to reevaluate your insurance policy on a regular basis to ensure that it continues to meet all of your requirements as your life and your finances evolve. Chapter 12. Real Estate. Understanding real estate investments. The purchase, ownership, management, and sale of real estate properties with the intention of generating income or profits are referred to as real estate investments. It can include a wide range of properties including residential, commercial, industrial, and land. Investing in real estate can provide a number of advantages, including consistent rental income, the potential for long-term capital appreciation, and portfolio diversification. However, it is critical to understand the risks involved, which include the possibility of fluctuating rental income, changes in the real estate market, and the cost of property ownership and management. To invest successfully in real estate, you must conduct research, understand the local real estate market, and have a clear investment strategy in place. Working with a financial advisor or real estate professional to guide you through the process may also be beneficial. Overall, real estate investments can be a great addition to a well-rounded investment portfolio, but it's critical to understand the potential risks and benefits as well as approach them with a well-thought-out strategy. Evaluating real estate opportunities. Those who are willing to do their homework and have a solid grasp on the market may find that investing in real estate presents them with excellent opportunities. To properly evaluate investment opportunities in real estate, you must first comprehend your personal investment objectives, then analyze the current state of the market, and finally become familiar with the associated dangers. When it comes to your objectives with regards to investment, it is essential that you decide whether you are looking for a long-term investment or a source of passive income. Your answers to these questions will direct you towards the kind of real estate investment that is most suitable for you. For instance, if you are interested in earning money in a passive manner, investing in rental property might be a good choice. Buying a property that needs some work but has potential for appreciation over the long term may be the better investment option for you. The current state of the market is one of the most important factors determining the profitability of real estate investments. It is essential to maintain a keen awareness of trends in the real estate market, including those pertaining to the prices of homes and apartments for rent, as well as the overall supply of available properties. You should also conduct research in the economy of the area, including job growth and population trends, to determine whether or not the region is stable and expanding. It is essential to have a solid understanding of the dangers associated with investing in real estate. Investing in real estate comes with a number of potential drawbacks, including exposure to market volatility, the possibility of property depreciation, and the difficulty of managing multiple properties. It is essential to be aware of these potential dangers and to have a strategy prepared to deal with them should they materialize. When evaluating opportunities in real estate, it is necessary to have a solid understanding of your personal investment objectives, the current state of the market, and the dangers that are present. You will be able to make well-informed decisions and increase your chances of success with real estate investments if you carry out the necessary research and preparation. Building a real estate investment portfolio. Because of the possibility of consistent income over the course of a long period of time as well as capital appreciation, many people consider real estate to be an attractive investment opportunity. However, similar to any other type of investment, it is essential to approach it with caution and a plan. The following are some steps that can assist you in constructing a profitable real estate investment portfolio. Specify your expectations for your investments. What do you hope to accomplish through the investments you make in real estate? Are you interested in earning a profit, growing your investment's value, or some combination of the two? A clear understanding of your objectives will assist you in arriving at well-informed choices regarding your investments. Do some research on the following. There is a wide variety of ways to invest in real estate, including buying rental properties, investing in commercial real estate, and purchasing shares in real estate investment trusts. Spend some time doing research and getting an understanding of the various options, their potential returns, and the risks associated with them. Consider your budget. Because investments in real estate can run to a high price tag, determining how much of that you can comfortably shoulder is essential. It is possible that you will need to either save money or look into different financing options. Diversify your holdings. The successful management of risk in any investment portfolio relies on proper portfolio diversification. Take into consideration making an investment in a variety of properties such as residential and commercial properties, as well as properties located in a variety of geographic locations. Collaborate with experts. Given the complexity of real estate investments, it is critical to collaborate with experts in the field, such as real estate agents, financial advisors, and attorneys, amongst others. They are able to offer direction, assist you in finding opportunities for investment, and make certain that the structure of your investments is appropriate. Maintain an accurate record of your investments. Maintain a regular check on the performance of your real estate investment to ensure that they are living up to your expectations. If you don't have the time or the expertise to run the day-to-day operations of your properties yourself, you might want to think about getting a property manager to do it for you. Putting together a real estate investment portfolio is an endeavor that requires patience, hard work, and strategic planning. However, if approached correctly, it has the potential to be a rewarding and profitable investment opportunity. Therefore, make it a priority to educate yourself, formulate a sound strategy, and launch your journey towards becoming a successful real estate investor as soon as possible. Chapter 13. Entrepreneurship. Starting a business. Beginning a new venture in business can be an exciting and rewarding adventure, but it also involves a great deal of planning with regard to one's finances. There are a lot of things to think about when starting a business, including finding the right business idea, securing funding, managing cash flow, and managing expenses. When starting a business, one of the first things you should think about is the financial goals you want to achieve. What do you want to accomplish with your company, both in the near and the distant future, and how will you measure success? This will help you determine the best idea and structure for your business, as well as the amount of funding you'll need to get it off the ground. The next step in developing your business is to find a source of funding. This can be accomplished through one's own savings, loans, or investments made by one's family and friends. You should also think about the various business structures that are available to you, such as sole proprietorship, partnership, limited liability company, or corporation, and select one that meets your requirements the most effectively. After you have secured funding for your endeavor, the next step is to carefully manage your cash flow while also sticking to your budget. This will assist you in maintaining an accurate record of your expenditures and ensuring that you have sufficient funds to both cover your expenses and generate a profit. You will also need to consider the recurring costs associated with operating your company, such as the rent, the utilities, and the insurance premiums. Last but not least, do not overlook the importance of securing adequate insurance protection for both you and your company. Depending on the nature of your company, this might include workers' compensation insurance, property insurance, and liability insurance. Beginning a business can be difficult, but if you put in the effort to plan thoroughly and put a strong emphasis on managing your personal finances, you can create a profitable, thriving enterprise for yourself. Building a successful business. It is essential to go into the process of building a successful business with a well-thought-out strategy in place if you want to make it one of the most rewarding experiences of your life. The following are several important steps that will assist you in achieving success. Carry out in-depth research on the market. Before you launch your company, it is essential to gain a solid understanding of both the market you intend to serve and the other companies in your industry. Carry out research on the market to ascertain both whether or not there is a demand for your product or service and what distinguishes your company from those of your competitors. Develop a solid plan for your business. Your mission statement, your target market, an analysis of the competition, your marketing strategy, financial projections, and your organizational structure should all be included in the business plan that you create for your company. As you navigate the highs and lows that come with running a business, you can refer back to this plan as a point of reference. Create a powerful brand. The company's identity, including its distinctive characteristics and core values, should be reflected in your brand. This will help customers recognize you as distinct from your rivals. Make an investment in professional branding and marketing materials so that you can establish a name for your company that is powerful and easily recognizable. You don't have to face this challenge on your own. Form a team. To assist you in building your business, you should look into hiring employees or independent contractors. Put yourself in the company of those who share your enthusiasm and commitment to the success of your company, and collaborate with them to realize your ambitions. Maintain your organization. The key to successfully running a business is maintaining a high level of organization and paying close attention to detail. Install systems so that you can keep tabs on your finances, oversee your employees, and simplify your business operations. Maintain your adaptability. Running a business is a lifelong learning experience, and you can expect to face obstacles at various points along the way. Maintain your adaptability and readiness to shift gears and make adjustments as required in order to achieve success. If you build your company with the help of these steps, you will be well on your way to having a prosperous company. Managing business finances. When you manage the finances of a business, one of the responsibilities is to make educated decisions about how to distribute the company's resources. This requires budgeting and forecasting. In order to be successful, you will need to be aware of the state of your company's finances, have a crystal clear understanding of your expenses, and be able to make educated choices regarding how and where to invest your resources. In addition to this, you will need to have the ability to create a budget, keep track of your expenses, and make sales projections. If you keep a close eye on your financials, you'll be able to make the best decisions for your company, which will in turn help to ensure that it will be successful over the long term. It doesn't matter if you're just getting started or if you have an existing company that you want to expand, efficient management of your financial resources is absolutely necessary to your success. Chapter 14. Career Planning. Understanding career goals. Having a clear idea of where you want to go with your career is an essential first step in creating a solid plan for your finances. You can create a roadmap for your future and make well-informed decisions about how to get there if you have a clear idea of the professional accomplishments that are most important to you. This might entail enrolling in classes to acquire new skills, continuing one's education to a higher level, or searching for new employment opportunities. In addition, having a crystal clear understanding of the career goals you want to pursue can assist you in making intelligent financial decisions, such as setting money aside for your retirement or investing in your education. You'll be able to make the most of your resources and construct the kind of future you envision for yourself if you set aside some time to think about the professional goals you want to accomplish. Building a successful career. It takes hard work, commitment, and an unmistakable vision of where you want your career to go in order to achieve success. The following are some actions that you can take that will assist you in achieving success. Learn new things on a constant basis. Keep your knowledge and abilities current by participating in ongoing education and training so that you can keep up with the latest developments in your industry. Build a network by establishing connections with others working in your industry and looking for mentors who can offer guidance and support. Take the initiative by accepting new challenges and responsibilities in order to illustrate your level of commitment to your organization and raise your profile within the company. Concentrate on the things that you do well. Determine what makes you special and then make it your mission to improve and exhibit those skills in your role. Maintaining a positive attitude is one of the most important factors that will contribute to your success. Put yourself in an environment with people who will encourage you and pay attention to the opportunities that come your way. It is important to keep in mind that building a successful career is a process, not an end goal. You can accomplish your professional goals and build the kind of career you want if you keep a clear head, put in a lot of effort, and strive to get better all the time. Planning for career success. When it comes to your professional life, it is essential to have a distinct idea of the goals you wish to accomplish for yourself. This includes defining your professional aspirations as well as the skills and experiences you require to get to where you want to be professionally. Spend some time reflecting on the things that really drive and excite you, and then create some objectives that are definite and quantifiable that are in line with these passions. It is essential to consistently expand one's knowledge and skill set in order to make progress in one's professional life and establish a rewarding career. Education, participating in training programs, and gaining experience on the job are all viable options for accomplishing this goal. Building professional relationships, which can lead to new opportunities and valuable insights, is another essential component of a successful career. In addition, maintain an attitude of openness towards new experiences and the possibility of failure, as these can both contribute to your professional and personal development. It is essential to have an in-depth knowledge of both the current job market and the fields in which one is interested when one is making plans for professional advancement and success. This entails maintaining a current awareness of the tendencies within the current industry as well as having a deep comprehension of the abilities and credentials that are in high demand. You should also make it a habit to reevaluate your professional objectives on a regular basis and make any necessary adjustments to ensure that you are moving in the right direction. Last but not least, always be on the lookout for new learning and development opportunities, and don't ever let yourself stop growing as an individual. In conclusion, developing a successful career calls for the combination of being self-aware, putting in a lot of hard work, and having a well-defined game plan. You can put yourself on the path toward a rewarding and fulfilling career by first determining what it is you want to do with your life, then regularly reevaluating those goals, then continually improving your skills and knowledge, and finally being proactive about looking for opportunities. Chapter 15. Family Finance. Understanding family finances. When it comes to matters of personal finances, it is essential to take into account not only your own well-being, but also the well-being of every member of your family. Examining your combined income, expenses, and debts is the first step in getting a handle on the financial situation of your family. In addition to this, it entails deciding upon certain monetary objectives for the family as a whole and formulating a strategy to achieve these objectives. One of the first things that needs to be done in order to get a handle on the finances of the family is to sit down with your partner or spouse and have an open and honest discussion about your current financial situation. This includes having a conversation about your income, your debts, your savings, and your expenses. This conversation may help you identify areas in which you may be able to make changes that will improve your financial situation as well as cut costs in certain areas. The creation of a budget is another essential component for family finances. It is essential to prepare a budget that takes into account all of your combined costs, such as those associated with housing, transportation, food, insurance, and recreational activities. In addition to this, you'll need to make preparations for long-term costs, such as paying for higher education or putting money aside for a down payment on a house. In conclusion, it is essential to include your children in the discussion regarding financial matters pertaining to the family. Teach them how to create a spending plan, how to save money, and how to make sound decisions regarding their finances. This will assist them in developing healthy financial habits and enabling them to make educated decisions regarding their own personal finances in the future. You can help ensure that everyone in your family will have a prosperous and secure financial future if everyone in the family has a basic understanding of the family finances and works together to make sound financial decisions. Planning for family financial needs. Planning for financial needs of your family can be a daunting task. However, it is important to have a solid plan in place to ensure that your loved ones are taken care of in the event of an emergency or if something unexpected were to take place. The following are some steps that you can take to get started. Determine the financial requirements of your family. Find out what kind of costs your family might incur in the years to come, such as those associated with housing, transportation, medical care, and education, among other essential costs. Establish specific, measurable, attainable, relevant, and time-bound financial objectives that you can work towards. These objectives should be based on the specific financial requirements of your family. For instance, you may have the goal of setting aside a particular sum of money for the education of your child or paying off a particular amount of debt in a particular amount of time. Make a budget. When you have a good understanding of the monetary needs and goals of your family, the next step is to make a budget for your family that takes into account all of the income and expenses that your family has. Ensure that you will be able to stick to the budget and make any necessary adjustments to it. Establish a savings account for unexpected costs. It is essential to have a savings account for unexpected costs available in the event of a financial emergency. An emergency fund should have enough money saved up to cover 3 to 6 months' worth of living expenses. This is a good rule of thumb. Think about getting insurance. You should make sure that you have the appropriate kind of insurance to protect your family in the event that something unexpected happens. This may include health insurance, life insurance, disability insurance, as well as insurance for your home or vehicle. Plan for retirement. It is never too early to start planning for retirement, even if you are just starting your career or your family is still young. Even if you are just starting your career or your family, it is never too early to start planning for retirement. You should give some thought to establishing a retirement savings such as a 401k or an IRA in order to increase the likelihood that you will have sufficient funds to enjoy a comfortable retirement. Talk to a financial advisor. If the task of planning your family's financial needs makes you feel overwhelmed, you may want to consider talking to a financial advisor. They can guide you through the process of developing a financial strategy that is suited to your unique circumstances and assist you in arriving at the best financial decisions for your family. If you follow these steps, you can help ensure that the financial future of your family is secure, regardless of what life may throw at you or anyone else. Building a family financial plan. When it comes to the finances of your family, it is essential to have the awareness that the decisions you make with regard to money right now can have a significant effect on the future of your family. Whether it's putting money away for a child's college education, purchasing a home, or making plans for retirement, there are a lot of considerations that go into creating a solid financial plan for a family's future. Before you can make a plan to provide for your family's financial requirements, you must first determine what those requirements are. Think about things like the cost of your education, the cost of your housing, and your future retirement plans. It is essential to take into consideration the possibility that your family's financial security could be jeopardized by unforeseen circumstances, such as an unexpected loss of employment or an emergency medical situation. As soon as you have an accurate understanding of the monetary requirements that your family must meet, it is time to begin constructing your plan. To get started, you should create some goals for yourself and a budget that takes into account all of your income and expenses. Think about making a long-term investment in a diversified portfolio of stocks, bonds, and other assets that can provide both growth and security over the long term. In addition, make it a priority to secure adequate insurance coverage for your family so that you can shield them from any potential monetary losses. You can establish a solid groundwork for the financial future of your family with careful planning and preparation. Chapter 16. College Planning. Understanding college costs. The price of obtaining a college education can be prohibitive for some people, and this expense has been steadily rising over the past few decades. It is essential to have a thorough understanding of the expenses associated with attending college in order to make appropriate preparations and decisions. This might include things like tuition, fees, room and board, books, and other miscellaneous costs. Scholarships, grants, loans, and even work-study programs are just some of the options for financing your education after high school. It is essential to conduct research, gain an understanding of the various options that are open to you, and formulate a strategy for how you will pay for your education. In addition to this, it is essential to have a thorough understanding of the terms and conditions that accompany each type of funding, as well as the potential repercussions on your finances over the long term. It is never too late to start saving for college and beginning planning for college costs as early as possible. There are actions that you can take to better prepare yourself for the expense of further education. Regardless of whether you are a student, parent, or grandparent, this may include setting aside money for college, researching the various types of financial aid available, and becoming familiar with the implications of having student loan debt. The secret is to get an early start. Make sure your goals are attainable and devise a strategy to achieve them. You can help ensure a prosperous future for yourself and your family by first gaining an understanding of the costs of attending college, the various options available to pay for it, and by planning for those costs. You can help reduce the stress and uncertainty associated with paying for higher education by properly preparing yourself and developing a comprehensive financial plan. Planning for college expenses. It is important to have a plan in place to manage the costs involved with going to college, because going to college can be a very large investment. In this chapter, we will discuss various approaches to financing your education at a college or university, as well as how you can position yourself for future success. Discovering the real cost of attending college ought to be one of the first things on your to-do list. This includes not only your tuition and fees, but also your room and board, as well as any other costs that may arise while you're attending school. You should also investigate the various kinds of financial assistance that are available to you, such as scholarships, grants, and loans, and think about which option might be most suitable for you. A college savings plan, such as a 5-to-9 plan, is one choice that you might want to take into consideration. You can get a tax break when you save money in this particular kind of investment account, which can also speed up the process of reaching the goals you have set for yourself. One additional strategy is to initiate a savings plan for higher education as soon as possible. If you begin saving for college at an earlier age, your funds will have more time to accumulate interest, and you will have fewer worries about how you will pay for your education in the future. To assist with the financial burden of attending college, you should give some thought to investigating work-study programs as well as part-time employment opportunities. In the end, being proactive and getting a head start on your financial planning for college are the two most important factors. Spend some time investigating your alternatives and come up with a strategy that will serve the needs of both you and your family. You can help ensure that your time spent in college is productive and enjoyable with careful planning and preparation. Paying for college. The cost of higher education presents a significant obstacle in terms of finances for many families. In recent years, there has been a significant rise in the cost of obtaining a higher education, which has made it increasingly difficult for a lot of people to afford. There are many different ways to finance higher education, such as through personal savings, scholarships, and grants, as well as through student loans. Because they do not have to be repaid, scholarships and grants are an excellent way to lessen the financial burden of attending college. These grants are typically granted to recipients on the basis of either merit or financial need, and they are available from a wide variety of institutions such as colleges, universities, and private organizations. Another common method of funding a college education is through the use of student loans. Students can use these loans to borrow money to pay for things like tuition and fees, as well as other expenses, but they have to pay them back after they graduate. There is a wide range of loan opportunities accessible to students, such as private student loans and federal student loans. It is essential to acquire an understanding of the terms and conditions of a student loan before applying to one. These terms and conditions should include the interest rates and the possible repayment strategies. Last but not least, putting money away for college out of one's own pocket is yet another option. Putting money away in a savings account or an investment account to help pay for their child's education is a common practice for many families who start saving for college early on in their children's lives. In the end, the method of paying for college that is most suitable for you will be determined by a number of factors, including the state of your finances, as well as the costs of the institution that you are thinking about attending. You can help ensure that you will have the resources you need to pay for your education and achieve your career goals if you take the time to research your options and develop a comprehensive plan. This can be accomplished by taking some time. Chapter 17. Health and Wellness Planning. Understanding health and wellness costs. The costs associated with health and wellness can quickly add up, which is especially true when considering the rising costs of healthcare as well as the growing emphasis placed on preventative care and the upkeep of a healthy lifestyle. In order to create a spending plan that takes into account the various costs associated with maintaining your health and well-being, it is essential to have a solid understanding of these costs. This might include things like going to the doctor, buying prescription drugs, paying for a gym membership, purchasing healthy food, and other similar expenses. In addition, it is important to have a solid understanding of your health insurance coverage, including what it does and does not cover. In order to make the most of your money, you can use this information to better plan for any out-of-pocket expenses that may come up as a result. You can ensure that you are prepared for any health-related expenses that may come up and that you are taking care of your overall well-being in a financially responsible way. This can be done by taking the time to understand the costs of your health and wellness. Planning for health and wellness expenses. Healthcare costs can quickly add up, especially if you or a member of your family suffers from a chronic condition or has ongoing medical needs. It is essential to make a financial plan in order to avoid being taken aback when the bills start rolling in. The following are some suggestions for budgeting for health and wellness related costs. Do some research and make sure you understand your insurance coverage. Find out what your insurance covers, what your deductibles and co-payments will be, and whether or not there are any limits to the coverage you receive. Establish a healthcare spending account by opening a flexible spending account or a health savings account. Both of these types of accounts can assist you in putting money aside for future medical costs, and in certain circumstances, you can pay for these expenses with your money that was put aside before taxes. Creating a budget for out-of-pocket costs. You need to make sure that you have enough money saved up for co-pays, deductibles, and any treatments that your insurance won't cover. Care for the long term should be planned for, and if you are getting close to the retirement age, you should think about how you will pay for care for the long term if it ever becomes necessary. Compare different options for medical procedures. Do not be afraid to compare different options for medical procedures. If you compare the prices offered by a variety of service providers, you might find an alternative that is more affordable for you. When it comes to the costs associated with your health and wellness, you can help ensure that you are prepared for them by planning ahead and being proactive about them. Managing health and wellness costs. Your overall financial strategy should account for the costs associated with maintaining your health and wellness. It is essential to have a thorough understanding of the expenses involved in preserving one's health in order to make appropriate financial preparations. This encompasses all aspects of healthcare, from screenings and checkups to more serious conditions that may call for more extensive treatment. Preventative care is one example of what is included in this category. It is essential to have a thorough understanding of your health insurance coverage, including the ins and outs of what is covered and what is not covered. In order to keep these costs under control, you may also want to consider additional insurance options, such as supplemental insurance, to assist in covering any expenses that are not covered by your primary insurance policy. In addition, taking measures to maintain good health, such as eating a balanced diet, getting regular exercise, and avoiding unhealthy habits, can assist you in lowering the costs associated with maintaining your health and wellness. You can help ensure that your overall financial plan stays on track by devoting the necessary time and effort to fully comprehend the costs associated with your health and wellness, and by formulating a strategy to effectively manage these costs. Chapter 18. Travel Planning. Understanding travel costs. Traveling can be an experience that is both exciting and fulfilling, but it also has the potential to be costly. It is essential to have a good understanding of the costs associated with travel in order to be able to plan accordingly and make well-informed choices. This includes the cost of travel expenses such as plane tickets, train tickets, or gas for driving, as well as the costs of lodging expenses such as hotels, Airbnb, or camping. You also need to consider the costs of food, entertainment, tours, and any other miscellaneous expenditures that you might make. If you are able to create a travel budget and save money in advance by being aware of these costs, you will be able to relax and enjoy your travels without being concerned about going over your spending limit. In addition, it may be beneficial to conduct research on the cost of living in your destination, as the cost of living can vary greatly from one location to another and can have an effect on the total amount of money spent on travel. Planning for travel expenses. When it comes to budgeting for your trip, one of the most important things to take into account is the total cost of your transportation, accommodations, food, activities, and any other costs that may come up while you are away. These costs can add up quickly. You should do some research and compare the prices of various options in order to make the most of the money you have available. You could also travel during the shoulder season, when prices are typically lower, or look for ways to cut costs on things like meals and activities while you're away. You also have the choice of setting money aside on a regular basis in a savings account that is specifically designated for travel purposes so that you will have enough money available for your trip. It is also important to factor in any unexpected expenses, such as trip cancellations or medical emergencies, and to consider purchasing travel insurance to protect your investment. Both of these things can be expensive. You can ensure that your trip will be memorable and stress-free if you take the time to properly plan for the costs associated with traveling. Budgeting for travel. When it comes to the costs associated with travel, it is not often to find oneself getting carried away and spending more money than necessary. Because of this, having a budget that you stick to is extremely important. To get started, you need to calculate how much money you have available to spend on your vacation. This should take into account the cost of travel, lodging, food, activities, and any other costs that may be incurred during your trip. When you have an overall plan for your finances in mind, you can begin to break it down into smaller, more manageable chunks of spending. Keeping this in mind as you plan and book your trip will be of great assistance to you. Next, think about ways to cut down on the money you spend on traveling. This can be done by booking flights during off-peak times, staying in accommodations that are friendly to one's wallet, and eating at more affordable local restaurants rather than more upscale tourist establishments. To further reduce the cost of your trip, you might want to investigate less expensive modes of transportation, such as flying on a budget or taking the train. It is essential to have a contingency plan in place in case of unforeseen costs. Make sure that you have a backup plan in place in the event that something goes wrong, such as your flight being delayed or you missing your connection. This may entail purchasing a travel credit card that also includes travel insurance or setting aside some additional cash to cover any unanticipated costs. You can make sure that your travel expenses are manageable and that you have an amazing trip without blowing your budget if you prepare ahead of time and stick to your spending plan. Chapter 19. Legacy Planning. Understanding legacy planning. The process of deciding what kind of legacy you want to leave behind after you pass away is referred to as legacy planning. This can include things like making sure that your values, traditions, and possessions are handed down to your loved ones, and it can also include financial considerations like making sure that your assets are distributed in accordance to your wishes. Learning about legacy planning is essential for two reasons. First, it prompts you to consider the things that are truly significant to you, and second, it ensures that your ideals and goals will be carried on after you pass away. Your loved ones and you can both benefit from the mental and financial stability that can be provided by a legacy that has been carefully planned. Building a legacy plan. The process of considering the impact that you would like to have on future generations and taking the necessary steps to ensure that your assets and values are passed down in a manner that is congruent with your objectives is known as legacy planning. The end objective of legacy planning is to make a long-lasting impact that will be to the advantage of one's family as well as the community at large for many years to come. The first thing you need to do to build a legacy plan is to get a clear understanding on your values and goals. Think about the things that are most important to you and what you would like to see reflected in your legacy. This could be anything from making sure that your family is taken care of to supporting a particular cause or community to making sure that your family history and traditions are kept alive. After you have gained an accurate comprehension of both your values and your objectives, you can then start formulating a plan to accomplish the former. This may entail writing a will or establishing a trust, establishing a charitable giving program, or making provisions for a particular member of the family or causes. It is also essential to take into consideration the potential tax implications of your legacy plan and to collaborate with a financial advisor or an attorney in order to reduce any potential tax obligations. This will help to ensure that your assets are used in the manner that you intended and that your legacy will have the most significant impact possible. It is essential to revisit your legacy plan on a regular basis and bring it up to date, particularly as your personal and professional circumstances evolve over time. If you approach legacy planning in a proactive manner, you can increase the likelihood that your ideals and objectives will be taken into account during the administration of your estate and the distribution of your wealth after your death. Leaving a legacy for future generations. Leaving a legacy for future generations is a way to ensure that your beliefs, values, and wealth that you have worked so hard to earn are passed down to the people and causes that are important to you. It involves planning for the transfer of assets and wealth from one generation to the next, as well as outlining your wishes for how you would like those assets to be used in the future. There are many ways to leave a legacy, including charitable giving, writing a will, establishing trusts, and transferring wealth through inheritance. It is essential to give some thought to the kind of legacy you want to leave behind and the way you want to be remembered. You should also think about your financial objectives and responsibilities in addition to the things that your loved ones require from you. A legacy plan is not just about money, it is also about imparting your core values, beliefs, and the lessons you've learned in life to the next generation. By leaving a legacy, you can ensure that your legacy continues to have a positive impact on the world even after you're gone. Working with a financial advisor and an attorney who specializes in estate planning can assist you in developing a comprehensive legacy plan that satisfies your objectives and safeguards your property. The most important thing is to get an early start on the planning process so that you will have enough time to make all the necessary arrangements and guarantee that your legacy will be carried on in the manner that you envisioned. Conclusion. To summarize, personal finance is an important aspect of life that necessitates time, attention, and dedication. You can take control of your financial future by understanding your income and expenses, creating a budget, creating a savings plan, and investing wisely. A comprehensive financial plan also includes building good credit, protecting yourself with insurance, and planning for retirement, taxes, and estate. By adhering to these policies, you can improve your financial situation and secure a better future for yourself and your loved ones. The key takeaways from this personal finance journey are straightforward. To begin, understand your financial situation and create a budget that works for you. Second, invest your money wisely and create a solid savings plan to help you reach your financial objectives. Finally, ensure that you and your loved ones are adequately protected through insurance and estate planning. Finally, keep in mind that mastering your money requires ongoing effort and a commitment to making informed financial decisions. Don't be afraid to seek professional advice and learn about various aspects of personal finance. You can create a secure financial future for yourself and your family with a solid plan and determination. So take the first step towards financial independence. Invest in yourself and your future, and you will see your hard work and dedication rewarded. Congratulations on your financial wellness journey.